Hey, welcome to Local Legacy. I'm your host, Nick Smith, where I sit down one-on-one, interview cool people with cool jobs and some amazing stories. Hey guys, this is my really good friend, Oscar Peccorini. He had some really good things that he taught me the other day, and I wanted to bring him in for more of an in-depth just conversation between the two of us. So I want to introduce Oscar Peccorini of Peccorini Financial. Oscar, tell us a little bit about why you got into the financial services.
Oh, wow. That's a pretty long story, but I'll try to make it brief.
Okay.
Because I go way back.
Oh, all right.
No, it's really interesting. When I was 28, I had a really great job working in the corporate world for Verizon Wireless at the time. And I was an account manager. My job was to service B2B corporations.
Mm-hmm.
And all of a sudden, if you remember, in 2001, the dot-com bubble burst.
Oh, yeah.
And the economy just took a dive.
Yes,
Stock market took a dive, a lot of layoffs. And instead of me kind of going out and pumping out more cell phones and more wireless cars and all the products that we were selling to the corporations, I was coming back home to the home office with boxes full of phones from people that were being laid off.
They started going the opposite direction.
Exactly. That's not the way you want to go. And, then, I started getting to feel like the company is looking at me as a liability, not an asset, right? Because I'm not not bringing in the business, right?
Mm-hmm.
Because it's a down economy.
Right.
So it made me really want to consider the next step in my, what do I want to do when I grow up? Kind of deal, right?
Right.
And shortly before that, actually, one of my uncles passed away unexpectedly, and that was a tragic thing that really made me also think about protection. Life insurance and protecting your family, and which are things that I didn't see that a lot of people had in place.
Right.
So that's what kind of led me, one thing led to another, and that kind of led me to go into this business and insurance, financial services. And that's kind of what I started getting all my licenses and
There you go.
and all that stuff. So,
And how long have you been in it?
since 2001.
Nice.
Yeah.
That's fantastic. So I touched on it a little bit ago. Oscar and I were playing golf, and we're at the 19th hole after a round, and we started talking about financial services and kind of getting set up. And I started asking questions from somebody who's not in that industry of what are the keys, what can I do to set myself up, how can I protect myself, my family, like what are the most important things that I needed. And then through that conversation actually led to this. So I really want you to share kind of that whole theory that you share with me.
Well, you want me to share like the actual thing that you didn't have prepared? And
Yeah, go ahead. Tell them. I'll tell them. I didn't have life insurance, and I need to have life insurance. I have a lot of assets at home, and 3 kids and a wife, and so I didn't protect them. So that really hit home for me, and so
yeah,
that's why we're here.
yeah, so that's really the foundation. So if you think about it, when it comes to financial planning, or there's only 3 things that could happen to you today that could affect your financial plan. 3 things. One thing is today, unfortunately, you could die.
Yeah.
Hopefully not,
Yeah.
right? But today you could die.
Mm-hmm.
Today you could become disabled and not be able to work and provide for your family. Today you could need some money as a result of an emergency. My AC broke down, or my water heater broke down, or something, or you could need money for an emergency and an opportunity. Some investment opportunity comes in, a flip.
Right. There you go. Yep.
You need some cash reserves, right? So those 3 things could happen to you today that could affect you financially. So for me, if you think of about a financial plan, it's like building a house, right? When you build a house, I'm not a builder, but most people know that you need a strong foundation.
Yeah.
Right? The stronger the foundation, the better, most likely, the house will be there long term, right? So your foundation for a financial plan is making sure that those 3 things are taken care of. Making sure that you have the proper life insurance plan, making sure that you have the right disability plan in case, to protect your family and your income, and making sure that you have enough money saved, put aside from some cash reserves. So those 3 things creates the foundation for a financial house.
Yeah.
Now, the rooms in the house, the living room, the kitchen, the second story, all those things, that becomes your retirement savings plan, your 401k, your college planning for your kids, your investment home, your next investment home, your vacations. All those things become part of the future plans as you build your retirement strategy.
Gotcha.
Now, to protect all that, the roof of the house per se would be what we call your estate planning. Your estate planning, that's where your wills and trusts come into play, your living trust, your more sophisticated type of life insurance to protect all those assets that you have. So that's the way I kind of try to explain it, so that the stronger the foundation, the better, because you got to take care of those three things, which that's kind of what alarmed me when I learned that you didn't have that one thing protected. So I said, build that foundation, buddy.
You got to build the foundation first. So we're actually in the works of building that foundation as we speak. So is there a way that you're able to then maybe leverage those things for other opportunities once you kind of have that foundation set up? So you mentioned actually 401k, and I had a 401k. Is that a good place to start? Is that a good idea?
Oh, absolutely. If you have a 401k available to you, participate in it. That's definitely something that if that's available to you. However, what I do ask individuals is, how much is your employer matching you on your 401k?
Gotcha.
So, most of the time that's 4%, up to 5% of my contribution to my 401k. So what I tell people is, then contribute to your 401k up to the match.
Gotcha.
Up to the match. Why? Because there are other vehicles available to you that may provide better benefits. For example, benefits where your 401k, see what happens is there are three types of investment incomes that you can build.
Okay.
The first one is your taxable income, right? That's your W-2 income. You buy a house, you flip it, you sell it, and you make some income. That's taxable,
Gotcha.
Right, that year. Then there's tax-deferred income, right? That's your 401k. With your 401k, you're paying from your paycheck. However, you're not being taxed on that money that you're putting away into your 401k. And that 401k is growing, and you're also not paying taxes, on the interest that's building up through the years.
Gotcha.
You never pay taxes on that money until you actually take it out in retirement.
Start to receive it.
Right? So that's tax-deferred income.
Okay.
And there is tax-free income.
Oh.
Tax-free income is, in my opinion, one of the best types of income.
Valid.
So tax-free income is the best way. And there are many vehicles out there available: Roth IRA, a cash value life insurance, municipal bonds. You can, talk to a financial, professional to get educated on the matter. But that's because if you think about it, would you rather pay taxes on the seed or pay taxes on all the crops that are going to be growing from that seed?
Right.
Right. I'd rather pay taxes on that one seed, right? So that is really a good way to understand different types of retirement income, because that's something a lot of people ignore, really. And it's important for people to get educated on the fact that the 401k, you never pay taxes on it, right?
Right.
The 401k, you only pay taxes until you retire and you take that money out.
Mm-hmm. So
the 401k, for example, let me ask you something.
Mm-hmm.
What do you think the tax rate? Right now, we're at 37%. 37% is the highest tax bracket, right? For high income earned right now. What do you think the tax bracket was, the highest tax bracket was for a high income earner in the 40s?
12%.
Okay. Would you be surprised if I told you it was 90%?
Holy smokes. Yes. Yes,
Yeah.
I would. I would think they would increase that over the years. Interesting.
Thank you. So in the 1940s, the tax rate, the highest tax rate for the highest income earner was 90%. So at that time, it made sense to defer your taxes. It made complete sense to pay taxes later.
Right.
Because who wants to pay 90% on their income?
Yeah, that's crazy.
So, of course, they came up with a tool called the 401k to be able to do that. All these are tools, and tools change all the time,
Mm-hmm.
right? Would you agree? Are you still building a home with the same tools that you built a home. No.
I actually tried to hang a TV last night with an old crescent wrench, and it got stuck on the bolt, and I had to beat it off. So 100% accurate. Yeah.
Right.
New tools are needed.
And I couldn't help you there because I'm not very handy. So you're sorry there, buddy.
Bad.
But tools change. So the 401k is just a tool that was created when it made sense.
Gotcha.
As years went by, especially in the Reagan administration, taxes went down, and those things make less sense now. Now the mantra really is tax-free income,
right,
and not paying taxes. You don't need to defer taxes anymore because economies change all the time. If the taxes were 90% at one point in our history, and you can Google this,
right?
If they were 90% at one point in our economy, do you think they might ever be at 90% again?
I would bet that they would probably at some point.
You never know, right?
It's a possibility.
But they could be. They've been there before, right? So why are you setting yourself up for future taxes, right? So tax-free is the way to look into that. And there are a lot of vehicles, like I said, that are phenomenal to create that type of thing.
That's very, very interesting. I never would have thought of that. That's fantastic.
That's cool. That's cool.
Yeah. So let's flip a little bit over, if you don't mind. I want to touch a little bit on home ownership. Obviously, and talk a little bit about clients or people that are purchasing homes, whether it be first times or they're moving to different areas, right? What are some of the important things that they need to make sure they protect themselves up front with what is most people's largest asset?
Right. In terms of protecting the home itself?
Yeah, protecting the home itself
or the assets.
And the assets altogether maybe is a better way to put that.
Right. Well, I mean, you can definitely start by getting some life insurance.
I see the trend here.
And make sure that, God forbid something happened to you, that the family will keep the house.
Right.
There's definitely ways to protect your home if that happens as well, from the house going into probate. And so you need a living trust. You need to create a living trust to make sure that the home is protected and your family doesn't have to go fight for the house against creditors and other family members, and things happen. In terms of protecting the actual structure, obviously, in our company, we actually do insurance as well. We Peccorini Insurance and Financial Services. So we have a tremendous clientele of insurance, and we do personalized insurance, commercial insurance, and all types of insurance. So insurance, homeowners insurance is a must. And as you know, that's a crazy market going on right now. It's absolutely a lot of stuff going on. We can talk about that too.
Yeah. So there's a bunch of people or companies that should say, right, leaving the state, not renewing in the state of California. Yeah. So it's wild. My phone is ringing with people asking me questions about that. I'm sure yours is ringing off the hook with people renewing and stuff like that. So why is that happening? Why are they leaving California?
Well, okay. So are you sure you're ready for this?
I'm probably not, but I asked it. So here we go.
So, it all starts back in 1998 in California. Proposition 103 was passed.
Okay.
Proposition 103, what that did is actually gave control to the Department of Insurance to regulate rates for insurance companies. At that time, in 1988, they actually forced insurance companies to reduce their rates about 20% back then.
Wow.
Yeah. They also included, red tape. In order for them to be able to file for rates increases, they had to file and have a review done through the Department of Insurance and get those approved. So those things, that started back in 1988. Insurance companies, were filing for rates. I think about easily within the last 10 years, if not more, the Department of Insurance created a different process for insurance companies who wanted to file for anything over 6.9% of a rate increase.
Gotcha.
So if you're an insurance company and you said, I need an 8.5% rate increase just to kind of stay afloat with the cost of my doing business,
right?
You had to, if you file for anything above 6.9%, you actually had to go through a hearing that sometimes would last about 2 years.
Oh wow!
Yes. So as an insurance company, you don't want to wait 2 years to get that.
Then you have to get another one, and you kind of never catch up, right?
Never catch up, exactly. Yeah. So most insurance companies were kind of filing for what would get approved right away, which was 6.9%.
Gotcha.
And over time, that started to kind of catch up, and rates were not where they needed to be. That's one factor.
Okay.
And then all of a sudden, you throw COVID in the mix, right? The pandemic.
Right.
The pandemic, now people are staying at home. right? They're using that bathroom that they never used before.
So true.
And all of a sudden now they discover they have a leak, or they created a leak, but because that pipe never got used before, and all of a sudden now there's another claim coming. So actually, insurance companies, their claims ratios went up tremendously during COVID and right after COVID. Conversely, on the autos, less people were driving, right? So less claims.
Right.
So that's why in California, did you remember getting a check or a credit from an auto insurance company saying, "Oh, that's nice"?
Yeah, it was very nice of them.
Well, and now it's the reverse because those claims. Yeah. Those claims started to come up.
Now they're back to my house.
Money back. Yeah, no money back. Yes, that happened. So the claims through the pandemic just went up tremendously. And guess what? We also had wildfires. Remember those?
Yeah.
I mean, so wildfires, massive catastrophic events in California. At one point, I read a statistic that about 4% of the state was in flames.
Holy smokes.
4% of the state. And that's huge. That's a lot of homes. And so, that cost, and then cost of living, inflation, right? Everything just started to get more expensive, to build a house, to fix a house,
right?
To fix a car, and those costs went up. But yet in 2020, the Department of Insurance forced insurance companies to freeze and lock their rates. They couldn't do a rate increase. So all those things caught up with them and caught up with the industry.
Right.
And this is where we are right now. We're trying to make sure that that's why insurance companies said, well, we can't do business.
Right.
We're selling, a dollar burger for 75 cents.
Right.
I don't care how much we sell in volume. We're not going to make money.
They can't even stay open, let alone profit, right? Exactly. As a business, we like to profit. So
exactly.
Wow, that's insane.
It's tough to understand as a consumer,
right?
But when you see those facts and those things that happen, it kind of makes sense.
When you pull the curtain back a little bit and actually look at it from a different lens, it's like, well, of course that makes sense.
Right.
I wouldn't do business in a state where I didn't make money.
Yeah,
doesn't make sense, right? Or even break even.
Right. So as of today, where we are is they're kind of negotiating with the Department of Insurance, trying to see where, because the Department of Insurance does not want companies to leave.
No.
Right. So they're trying to work and make it work for insurance companies, the consumer, and they have a tough job.
Wow. Yeah. Wow. That's crazy. That's crazy. Does that mean my rate's going to go up?
Oh, man. I wish I had better news for you. I don't want to be. Yeah.
Thanks for breaking it to me easy.
I got some bad news for you.
Yeah.
Yes, you're right. They're gonna.
Okay.
Well, I mean, the insurance companies have filed already. They're being looked by the insurance company, by the Department of Insurance, and you should expect. I mean, I think it was on the news. I don't want to say the name of the company because I don't know, but 20% increase average in California for one of the biggest insurance companies. They just announced it last a couple of weeks ago. And those things are coming for everyone. Yeah, unfortunately.
Unfortunately, there's nowhere to go. So I want to circle back to something we touched about when we first started talking was permanent life insurance versus term life insurance.
Oh, yes.
Go over that difference again with me.
Absolutely. The way I'd like to explain that is term life insurance is like renting. Okay. When you're a renter, you're getting, for the monthly payment, you're getting the benefit of having a roof over your head.
Okay.
But are you building equity?
No,
you're not building. I'm asking a realtor, right?
Yeah,
of course. You're not building any equity,
right?
You're not. You're just spending the money and throwing it away, right? Throwing it away for the protection. Now, of course, you have the protection, right? Of a roof over your head. With term life insurance, you're paying a monthly premium that's a lot lower. Let me ask you something: is renting cheaper than owning a house?
In most cases, yeah.
In most cases, yeah. It depends on the market.
Yeah, exactly.
Right?
But yes,
but in most cases, generally speaking, I guess. So renting a policy, term life insurance, like you're renting a policy.
Gotcha.
You're not getting anything out of it. If you use it, great. If you don't, which you don't want to use it.
Right.
And term also refers to the fact that the term is the period of time that your price is locked in. So you have 10-year terms, 15-year term, 20-year term, 30-year term is sometimes the most you can get.
Okay.
And so that means that your price is only locked up for that amount of time.
Gotcha.
And that's why it's cheaper.
Okay.
Right. After that, it goes up astronomically. Nobody keeps those rates after the term expires.
Gotcha.
Okay. So that's term life insurance. Permanent life insurance, that means you're permanently locking up that price, locking in that, like whole life insurance, like our grandparents used to have whole life insurance. And what that means is your price, your rate is permanently fixed for the rest, the lifetime of that policy. So you're locking in that payment. Since the 80s or in the 90s, there have been a lot of different type of permanent life insurance that have come up, and that use investments or savings components to it, where you can actually build some equity.
Oh, wow.
On top of the monthly payment that you're paying. You can actually pay it off in 20 years, 25 years, 15 years, whenever time you want. You can modify those policies to the client's needs, and you can build cash value on those policies that you can actually access tax-free on those permanent type plans. So permanent provides you with more flexibility in terms of payments. Do I want to pay it off sooner? Do I want to? But the coverage is guaranteed for life, and you can also build equity,
Right.
in terms of,
Because it's like owning a home. You can pay that thing off whenever you want.
It's
Like, don't lose the equity. You can use it for different things. Right. You can borrow against it or whatever.
So whenever you think term life insurance, think renting.
Yeah.
Permanent life insurance, think like buying a house.
That's a perfect analogy.
Cool.
That's fantastic. Cool. My goodness, that's a lot of information. I want to give you an opportunity. Maybe if people have more questions, they want to reach out to you directly, kind of dive deeper. This is all 10,000 foot view. Fascinating information to me. How do we get in touch with you?
Oh, absolutely. You can contact me directly at my office, 925-684-7055. That's my office number. You can send me an email at oscar@peccorinifinancialservices.com. And look me up on social media, Oscar Peccorini. You'll find me.
Perfect. Hey, I really appreciate it. Now let's go play golf, and maybe we'll learn some more at the 19th hole again. All right, let's go.